Okay, I want to go over my underwriting calculator that I created here. So if you look at the bottom, there's three tabs. There's income and expense, there's a mortgage calculator, and then you have the final analysis, which has your cash on cash return. So, obviously I'm going to use this calculator to run a live deal to show you how to use it, but I just want to go a quick overview. So here, just put the property owner name if you want to, the address, number of units. So you want to put like if it's 11 units, 12 units. So I think I was underwriting a deal here, so I have some numbers left over. But if you put the number of units, it'll calculate it on a cost dollar per unit basis for both the unit and the pro forma. So if you want that equation there, that's how it functions. So if you look here, you got your rent income, so the gross, potential income. So this is going to come from the T12. Exactly, you don't need to put the vacancy, concessions, or bad debt for current, or you can mimic it if the T12 says it, but I just keep it simple and just do the, gross potential rents. If you have other income like laundry income, garage income, rubs, and anything else, you can populate it here as well. Um, so, here it gives you the effective gross income. So that adds up everything, right? So that includes the rent income plus the other income. And then for operational expenses, you can break it down. There's a lot here. Accounting, administrative, advertising, real estate taxes, insurance. Remember, your insurance will always be higher than their insurance. And any repairs. So, electric, gas, sewer, water, trash, utilities, landscaping, property management fee. You can put in a percentage here. Um, for me, I because I always just do 50%, to be honest. And I put it here, expense ratio should at least be 50%. I'm lazy, so I just kind of like, I take my effective gross income and I just cut it in half. And I just put it here and it calculates it for you. It's 50%, right? So, and then at the end, you have your net operating income, which is just the income minus the expense, right? So this will calculate it for you. There's a formula here. And then for the pro forma, obviously you would do your gross potential rent based on, what you got from your property manager, what you got from rentometer, what you got from Section 8. So you want to include that there. For vacancy, for pro forma, you always want to make it 5%. For the pro forma side, for the current, since you have the actual income, it already factors in vacancy. Any bad debt, concessions, any other income, if you expect to bill back rubs, if you expect to rent out some garage units, if you expect to add washer and dryer, you can add all this income here. And now you have your new effective gross income, right? And then what you want to do is you want to make sure that the real estate taxes, you can find that online by searching the rate. I think I have a video showing you just calculate the percentage times the new purchase price, that's your new real estate taxes. For your insurance, it's always going to be at least 2 or 3 times more than the current owners, because they don't buy replacement costs, and they don't buy. You're buying it at, if they bought the property for $1 million and their insurance might only cover $1 million, but you're buying it for 2 million, and you want to make sure you cover at 2 million or at least replacement costs to ensure that things go according to plan. Right. For me, I'm like I said, once again, I'm pretty lazy here. So usually I'll just kind of take the expense from the current and move it over to the pro forma. Because even when you raise the rents up, your operating expense doesn't increase that much. But, as you can see here, it's going to be like 24%. So maybe I can bump it up a little bit more. Right. But you just need a feel for it. Like, because like when you raise the rents, because it's the economies of scale, right? Like your property management might go up a little bit, but your property tax stays the same, your insurance stays the same, the repairs and maintenance stays the same, regardless if you're charging $700 per unit or $500 per unit in rent, right? So you do get that economies of scale, which is nice. So here, once you get your NOIs, you can go over to your mortgage calculator tab. So I broke it down in two options. You got your principal and interest um, mortgage calculator, and you have your interest only. Right, so let's go over the principal and interest first. Let me make this a little bigger. So here you want to do your loan amount. So, I just assume a 25% down. So your loan amount will be 75% loan to value. So you just can do the math, right? You can do 75% times your purchase price. Annual interest rate, I just put 8% here. Life of the loan in years, so it's 30 years. It's usually 25 to 30 for apartments. But And the number of payments per year, obviously it's 12, number of payments 360, so it calculates that automatically here. So there's a formula built if you see the equal sign. Um, and then it'll calculate your payment per period. Um, it has a formula built in here. So, based on this loan of 273,000, 8% interest, 30-year AM, my monthly payment is about 2,000. My annual payment or debt service is 24,000, right? So that's how you do it. And then if you do interest only, like if you want to do creative financing or you have the interest only option, you just do your loan amount, you get your 8% interest, and then it's a simple math, right? So you just do, it shows a formula here. You do the loan amount times 0.08%, and you divide it by 12, and then you do your payments per year is 21,000 or about 22,000. So you save about $2,000 a year, right? So this calculates that, and then you have your final analysis tab. So I have it for the current principal and interest, and pro forma principal and interest, and then current interest only, pro forma interest only. So here you put in your offer price, you put in your down payment. It should calculate your down payment obligation here. And then the net operating income, it'll pull from the first tab. So it'll pull this number and this number for the current, the NOI for the current, NOI for pro forma. So it's going to pull that there for you. Your debt service, it's also going to pull it from this tab. So on an annual basis, it's going to pull it from here and here. And then it's going to calculate your cash flow annually. So it just takes your net operating expense minus your debt service. And then what's your net cash flow on a monthly basis? So you just divide by 12. It calculates your debt service coverage ratio, which remember it's your NOI divided by your annual debt service, and it should be greater than 1.25. So here it's 0.96, so it's not good enough, right? And your cash on cash return calculates that here. Ideally you want around 8 to 10%. I have some people do about 6% if you're comfortable and you make money elsewhere. So this one's negative, and here's your cap rate. And if you look on the pro forma, same thing. It calculates your offer price, down payment, debt service coverage ratio. Obviously, if you're doing your value add plan, the cash flow is increased on an annual basis. You're getting $4,000 a month. Your debt service coverage ratio is 3 now, so it's way above that 1.25. Cash on cash return is 53%. Your cap rate is 20%. The market cap rate is 8%, and you can calculate your new value, right? So you just take your new NOI divided by your market cap rate. So I bought this for $360,000, and now it's worth $900,000, right? And then it's the same concept here if you have interest only as well. So it calculates everything for you. So overall, your key numbers is what's your cash on cash return. You want at least 8% day one, ideally. And what's your cap rate day one? So it should be, the market cap rate. So hopefully the market cap rate is 6%. And then as you increase the NOI, it's going to blow up your cap rate to 20% here. And then at that point, that you can do a cash out refi, right? So you can pull all your initial money and your down payment. So, I'm going to run through a live deal using this calculator, but I just created this for myself, and I'm going to share it with you guys, right? It's very simple, not complicated. KISS, keep it simple, right?